Hi, everybody. Good morning. This is Friday, August 30th, approaching about uh, almost 11 Eastern. Relatively quiet day. The PCE came out as expected. SPX is up 30 points, and VIX is down a little bit at 15.19. This is Dan Sheridan and from Sheridan Risk Management. And today I'm going to speak a little bit on option skews and weekend time decay, and how does it affect you as the trader? And I spent over 20 years in the pits in Chicago. In the pits, when you say in the pits, it's like uh, uh, the depths of despair or something like that. In the pits, trading as a market maker and specialist. And so I have firsthand knowledge of kind of what happens with this magical weekend time decay. How do you, as the retail traders, get all this weekend time decay? And my thought is, boy, who are those baboons on the other side of the trade? They must not just know what's going on, right? When retail traders can come in and sell options on Friday and get all that decay, do you ever think who are the baboons? And I'm not saying most of us aren't baboons uh, on the other side of the trade, but is it lack of knowledge or what's going on there with the trade? Why are they letting you get this free theta or whatever retail traders think they're getting? Let me explain this a little bit. So I'm going to talk about real quick what's going on here with this option skews and weekend time decay. And then I'm going to talk about um, a couple trades that we've been doing in the community, and I've done personally for years, and why how that can be a bit of an edge. After I explain some of the information, and then I'm going to throw out for something you to keep an eye on. VIX, if you look at the last year or whatever, if you went to look at it, VIX is, I would say, 85% of the time it's up on Monday morning. And why? And I will talk about that a little bit. And we'll go from there. So for some of you, this may be the first time you've heard this kind of discussion, or maybe these terms seem a little weird. You haven't heard them. Others, you might have heard them and you're experienced at them, but maybe you heard it a little differently, right? Or maybe you heard something different. And so this would be good for both levels. So if we look, here we are, Friday, August 30th. If I look, today is Friday. Now Labor Day is Monday, so that's an off day. So you have this September 3rd, the at the money calls. SPX is trading at 56.26. The at the money calls, the 56.25s are trading at a 7 volatility. And then if you go a week out to, if you go a week out to, because that would be a Tuesday, then if you go out, that's SEP 3, 4 days out. If you go to, what would be the Friday then? SEP 6th, right? SEP 6th is a week from today. The implied volatility is 11.4. It's 4 points higher, right? Now, I'm going to throw one other concept in here. Some may have heard this term called Vega, but and I'll throw one other data point so you can see that. So next Tuesday, we're up on Monday. The implied volatility right now of an at-the-money call is 7.33. They're trading around $19. This is SPX. It's a $5,600 vehicle. Options are more expensive. SEP 6, they're trading 11.59. Options are $39. What if we go out to a couple more data points? SEP 13, 14 days out, we're 11.4 volatility. And then if you go to one more data point, 3 weeks out, you're up at 11.6. So let's deal with a couple terms. So first of all, in a low volatility environment, which VIX is about 15. So that would be the lower end of the volatility, especially over the last 6 weeks. Over the last year, the VIX levels, 15 might be a little under the middle, right? But when VIX is 15, 14, the market generally is going up. Price goes up, volatility goes down. And so when you see this lower volatility and shorter dated options and then increasing, what's the big ugly word on that one? It's not a dance, contango, right? That's normal structure, right? And normal structure. Now you say, well, versus if you look at, and here's another fancy word, term structure is just describing and is basically saying the obvious that different expirations, SEP 3, might have different considerations and volatility considerations than other expirations. Yeah, I mean, it could be news coming out or a different demand and supply for that expiration. But so term structure just is basically saying, hey, Sherlock, there's different volatilities associated with different expirations. I get it. So why is this 7? Well, part of it is what makes that lower than here. Part of it is you have this holiday coming up Monday. So the market makers in the pit, of which I was one of those, they're lowering the volatilities. Now that sounds diabolical, like they have some power. They don't. What happens is there's supply and demand. There's probably more sellers of options Friday, today. You're going to have Saturday off, Sunday off, Monday off. So these SEP 3rd options that expire next Friday, they won't be trading again until next Tuesday. So because there's sellers, more sellers today, what did I do when I was in the pit? I would just, okay, someone wants to come in and sell some options, the SEP 3 56.25s. I'm paying 17.20. A couple people sell some options. Okay, now my new bid, I paid 17.50. Now I'll pay 17. I'm lowering it, and when I'm lowering the volatility, the bid ask, because there's more sellers, not because I have some authority to do that. The volatility comes down, so I'm ticking down the volatility. I can lower the volatility by lowering the bid. And then what happens Monday or Tuesday, I'd say 90% of the time, historically, could be 85% of the time, but Monday VIX is up, at least in the morning. Why? Because the market makers, the sellers, aren't there, because it's not the weekend time decay. And so they go back where they should, probably, next to the other stuff, 10 or 11. Right? That's just the way it works. There's no conspiracy or anything like that. This other term, especially, I think is important to look at, is called Vega. So you may think that, 1 point of volatility, probably be a little mean, Morty, if if you look at here's a 4-day option, right? 4-day option. And it's 7.42 or 7.41 volatility. And it's trading at $16. Vega is 2.4. What does that mean in English, Spanish, and Somalian? It means that 1 point of volatility equates to 240. What do you mean? If volatility goes up a point, right, this option will go from 16 So if this goes from 7.41 to 8.41, volatility or the price will go from 16 to, add the Vega, 18.4. What if volatility goes down a point to to 6.41? We drop a point, this price will go from 16 to 16 minus 240. That'd be like $13.60. So I don't get that much as caught up as you might think in implied volatility with 4 days to go. Why? Okay, 1 point of volatility equates to $2.35. Let's talk perspective. Let's go look at a 34-day option, right? A 34-day option is trading higher at 11.34. 1 point of volatility and a 34-day option is almost $7. So that's 3 times the amount, right? So if the volatility drops, if the volatility goes up or down 1 point in a 4-day option, it's affecting it by about $2.40. 1 point of volatility in a 34-day option is about 3 times that amount, or in this case, 6.82. So how does that apply to you? You should be more worried about, if I'm wrong on my volatility assumption on a 4-day option, it's not as big of a problem as if I'm wrong on my volatility assumption 30 days out. So to make a long story short, I have found good success for myself and folk in our community over the years doing calendars on Thursday. Here's an example of a 4-day calendar. If I look at it at the money now, this would be a calendar. Calendar is just a mixed month spread where you're buying the further out option, selling it closer in at the same strike. A mixed month spread, like a diagonal just means mixed month spread, but different expirations and different strikes. So calendar, if it's a mixed month spread, the same strike. And if I put those options close to at the money, we're trading at 56.06 here. And in this case, I'm buying a SEP 10, selling a SEP 6. That would be called the calendar. SEP 6, in this case, is 7 days from expiration. And you can see when I do a spread 7 days from expiration, you can see, look, I'm buying at 11.3, selling at 12.4. And you get all excited and say, wow, I'm buying cheaper than I'm selling. That must be great. Well, the reality is the implied volatility of short-dated options will conform to short-term events, and they'll spike when the underlying price movement is volatile, collapsing when it is not. Longer-dated options will respond differently. So you can see here a positive skew, and this is I'm selling an option 7 days out, buying an option 11 days out. But if you go look at if I want to go to a 21-day option. So here, if I'm selling a SEP 20, buying a SEP 24. So I'm keeping that same 4 days difference between the long and the short in the same strike. The skew disappears. I'm buying at 12.16. I'm buying at 12.15, selling at 12.53 or whatever. So there might be a positive skew. My short is over my long by about 40 cents. In shorter dated options, it's easier to get a bigger skew. Here it's almost, if you're watching for a few minutes, it's closer to a dollar, right? Here it is, about $1 difference by 11.3. sell 12.3. So people have some very different ideas about what this means. So I like these shorter term calendars, 15 days and 9 days, because what happens is, I would say 80% of the time, I'm out by Monday if I put them on Thursday, because I'm getting, because they're putting pressure on the shorter, my short options over Friday, I'm getting more benefit. And so I can either get out of them if I put it on Thursday, on Friday, or Monday. And that's an advantage being near that weekend. That's how I've used it. So anyway, just some discussion. Hopefully, it'll get you thinking. If you have any questions, you could email me at Dan@Sheridan riskmanagement.com. And you could check out our site if you want at SheridanRiskManagement.com. If you just go there, the way I have it structured here is a subscription for, if you go to the front page and just hit subscribe at the top, you could look at, we have the pro plan, and basically for $194, the way I do it is you get everything. You get 2 to 2.5 hours of live content a day. That's and we're usually doing live trades every day. 2.5 hours of live content, and it's all recorded. You can watch it usually an hour or so after. But all the on-demand classes, I just finished today. I'm finishing up a volatility series of about 15 hours on calendars, butterflies, and credit spreads in a volatile environment. All of that's included. All the on-demand classes, we'll be starting up a Discord group in the next couple of weeks for people who, if they don't have as much time during the week to watch it. But you're getting, for those of you who like, my purpose isn't an alert service, but we're going to have all the trades. You can see them, you can see how they're doing, but you can learn the craft. My idea is to teach you the craft. So you're getting everything, all the courses. The only thing you're not getting, if you wanted some one-on-one mentoring, you needed a little extra help, that would be extra. But I'd encourage you to try a month, $194, and by coming in, you get all the classes, all of our on-demand classes, just the credit spread calendar, and Iron Condor, 10 hours of that. Normally would do those separate. That would be easily $500 or $600 just for that. But here for a month, you would get all the live content during the day, plus all the classes, as long as you're subscribed to it, but you get it for a month. So anyways, I want to encourage you, if you're interested in learning the craft, or if you're more experienced and you want to pick up more ideas, especially risk management is where we focus, adjustments, but live trades, check that out. Folks, have a nice day, and we'll see you next time. Thanks. Again, you can email me, Dan@Sheridan Risk Management, if you have any questions. Thanks.